Is there anyone here in the room from a meat producer company, something like that, or large industrial, or more trading side? Do we have traders in the room? Okay. Any trader user particular risk models, for example? Value at risk, cash flow at risk? Or not at all? Or too scared to mention, because that's why people hide behind their telephones quickly. A little bit about Kyos, a little bit about myself. We are a Dutch company, existing since 16 years. Before that, I worked 20 years for a financial institution since 1986. Also worked 2 years for an oil trading company to get more knowledge about physical oil trading. We have some small names, we have some big names as a client. Shell, big name, of course, also in the Netherlands, the Exxon Mobiles, but also Cornielje, but also smaller clients as well. And some of them are traders, some of them are industrial companies, some of them produce. So it's really depending on the type of client that we do some things for them. And today, I'm going to take you into a meat producer company, but also, of course, step by step with all the other things that can be relevant for you. I think what we do compared, for example, to ERP systems, like Dicotrade, my friends of Dicotrade, they're really in the ERP side of business, or with TMS platforms, the treasury side of the business, the currencies, the interest rates, that we don't really focus on logistics. Yeah, we do a little bit of inventory management, but I think that's really part of the ERP platforms. They're way better than us in those kind of things. There is overlap sometimes in positions, cash flows, mark to market. Of course, that's what we do, because that's also the next step into more in-depth risk management. Because we really focus on P&L kind of reporting and risk reporting. So, for example, MTM valuations, stress testing of prices, what many clients are doing in Excel, and now we have these kind of elements all automated in systems like ours. But also, from a trading perspective, value at risk, what can happen with the MTM in 1 day or 5 days or 10 days, or if you want to in 25 days or 26 days. But for the large industrials, they really focus, especially for the CFO, for his bonus for the next 3 years, because that's the average tenure of a CFO, I think, in the US. They really look at the longer term risk, so 3 years, sometimes 4 years or 5 years. So how do we add value to the change? It's combining data. You have an ERP, you might have a TMS, you might have something else, or Excel. We combine the data. So we combine the physical flows with all the financial hedges. We do the cash flow forecasting, but not only in terms of where we think prices are heading, because I must admit, I started in '86, I still work. I think that says it all. Don't trust me about the direction of prices, but what we do, and I'll show that later on as well, what we do well is creating a realistic bandwidth of market prices, and we combine it with volumes. And then we have a bandwidth of a potential cash flow distribution. But again, this is also important. With hindsight, everything is easy. And there are many friends of mine that could predict the market, but only when it already happened. I'm not that good. If we look, for example, at this particular case that I want to show you, there's a lot of data available. And I just spoke to a client that also said, well, sometimes I'm active in a market with not traded commodities, at least not exchange-traded commodities. They are traded, but it's a specific product, not that much of information. We also see and have many of those type of clients. We have, for example, Hogs as a client. It's one of the largest dairy trading companies in the world. And yes, they trade cheese, but there are many different kinds of cheeses. I must admit, most of them I don't like, from a taste standpoint. Although I'm Dutch, so. I think what is also really interesting when we talk to people that are really experienced, it's the difficulty of bringing together, and that might be also a difference of age, bringing together the experience that you have, I call that the brains, with many people that do procurement for 10 years or 20 years, the gut feeling, and all the smart guys nowadays from the university with all kinds of models and AI and whatever. But the difficulty is bringing it together. It was already 10 years ago when I visited one of the largest breweries in the world. And the guy was telling that he has been doing this for 20 years and lots of experience. But I said, the problem is, that's not the answer that you can give to your CFO. You need to have a combination of data, analytical function, and yes, your experience. And very often that's that brain of yours, because you're doing this business for 20 years. It combines it all, but sometimes it's difficult to express the way your CFO probably wants to hear it. Better prepared, and also for more people within the organization, from the CEO or the CPO or the CFO. So the trick is, how can you bring data together in an understandable way so people understand what they're looking at? And that's also what we try to do. Also with risk, sometimes you can just hide and say, yeah, I'm sorry, but, things can happen, or you can take some risk. This is also what we see when I worked at the dealing room. I was speaking to most of the clients on the left-hand side, corporate clients, risk averse. They rather save money for the client than for themselves. Because you're working for the client, you're proud to be working for them for 20 years. And we have the traders on the right-hand side. They have loyalty as a dog. If someone is paying more salary, then probably they leave. I don't want to offend anyone, but okay. So you need to combine things. And for example, here on the meat market, there's a lot of data. If a pig is 6 months old, it's ready to be slaughtered. I'm not a vegetarian, and everyone is allowed to eat what they want to. But there's a lot of data. How big is a pig after 6 months? So you know how much they have eaten on corn, for example, and soybean meal. So if we start risk management and we start a case, we need to define with the client, okay, what is your starting point? You need to buy corn. Yes, you need to buy soybean meal. Yes, and you're going to sell a lot of pigs, and we call them in the market lean hogs. It's more user-friendly, I think. But this is a starting point. And with the starting point, there's also a potential risk, and we can calculate the risk because we have a starting point. We know the cost of corn, for example, for 26, based upon current market prices. We know the current value of the soybean meal, based upon the volume that the client is going to consume. And also we know what the value is if they would hedge their total 2026 position. But like in real life, people are not hedging their complete position for 26. For the traders, it's a little bit too dull, because you want to beat your competitor. So yes, you are hedging, you are buying, you are selling. Sometimes you make some margin and you sell and you have an open position again. But that's the role of a trader. But also for the industrial client, they also don't want to hedge everything at one time, because maybe your competitor is not hedging. So it's always finding a balance. Okay, what do we expect? What is the risk? And I think that's the most important questions. What is the risk? And most people have difficulty in making these kind of calculations. So what we do, and it doesn't really matter if it's metals, it can be magnesium, it can be dairy, it can be the milk, it can be butter. And in this situation, it's soybean meal, it's corn, and it's the lean hog side. So we know what the volatility is. How volatile are the prices going up and down? But then the next step is, how can we translate volatility in real dollars? That's the next step. Some of you know that I live in Italy. And no, it's not my view. So yes, we have a nice house. I also have folders of my bed and breakfast, by the way, but that's a different story. So if you come to Italy, visit me, you must do. But if you go on a holiday for the next 10 days, one of the questions is, okay, are you hedged, yes or no? What can happen in the next 10 days with your cash flow? But for the CFO, like I said, his horizon is different. What can happen in the next 2-3 years? So it's always a balance. And we calculate both. So for the short term, we calculate value at risk. And I think most of the traders here in the room, they are familiar with the concept of VAR. So what can happen with the mark-to-market or the total value of your position in maybe 1 day or 5 days or 10 days? Or some clients want to know 21 days or 22 days. I'll send the presentation afterwards. Or sometimes I see someone with the glasses up and off, but I'll send the presentation afterwards. But what we calculate in the VAR is, okay, what can happen with the value of your position in maybe 1 day or 5 days or 10 days. For the CFO, it's nice to know, but yeah, he can't go to his shareholders with that kind of information. For the procurement teams, it's relevant. It helps you to understand, okay, I am going on a holiday on my team, and what can happen with the value of our position. So it's a starting point, short-term risks. In systems like this, we calculate the VAR every day. So we can also compare VAR. And I think also what you see here, if you add up the value at risk for all 3 commodities, that total sum is higher than if we would calculate the VAR on a portfolio of commodities. And I think this is an important takeaway for clients that have multiple commodities in their portfolio, that the VAR of individual components, depending on the correlation, we can talk about correlation later, it will influence the total VAR. So this is an important takeaway. But like I said, this is for the short term, and we also focus on the longer term. If you look at VAR, there are a few things that you should understand about VAR. VAR is nice, but like many things, it's never perfect. Our system is good, yes, it's very good. Grupo Bimbo says that, Cargill says that, Keurig Dr. Pepper says that, but it's not perfect. I'm sorry. But we do our best. But you have to realize that we make assumptions, we make analysis, we make calculations. They are not perfect. But sometimes it's a matter of being consistent. And that already helps you in starting to understand market price risks. Perfect, no, but it's going to help. What we also do is creating Monte Carlo simulations. So we are here with 30, 40 people in the room. If I would ask any one of you about WTI or corn or magnesium prices, you would be able to say something. No good or wrong, but this is also what we do with potential price paths. 10 price paths or 50 or 100. But for Monte Carlo simulations, it's not enough. We run 1,000 or 2,000 to 10,000. Just to make sure that we have a good distribution overview of potential market prices. And then we have the ability to say something with 95% certainty for the next 2-3 years. And then we combine it with volumes. So we combine it with the volumes of corn to be bought, soybean meal to be bought, and the lean hogs to be sold as the sales side. So we know the current value, 200 million, for this portfolio, buying the corn, buying the soybean meal, selling the lean hogs. And we can also calculate the worst case scenarios. And yes, it can be negative. Very often in real life, it's not going to be negative because clients are starting to hedging upfront, but not the complete portfolio. But I think the interesting thing is, if we calculate the 95% at risk, it gives them insight. What can happen statistically with the total portfolio of commodities? The corn that they need to buy, the soybean meal that they need to buy, the meat they're selling. And now we focus on the risk side, but of course we also have the upward potential. But I think this is really, really important. What we see as hedging tools in the market, I think most of you will know financial swaps, call options, put options. But there's one thing I want to mention because it's quite unique. What we see in the market as well is accumulators. For me, a client can use whatever he wants. But I always say, do you really know what you're doing? Can you make the same calculation about the call that you're buying or the put that you're buying? And with call options and put options, it's easy. Browse a little bit on the internet and you can download some models for calculations. But the trick, for example, with accumulators is they look nice, yes. And I've sold a few in my days at the bank. But nowadays, sometimes I'm a little bit ashamed of the money we made. And now I'm trying to help clients that say, okay, we do the valuations. Yeah, I say a little bit ashamed, not that much. It's also fun for working for a bank, I must say. And it's the same, for example, working for a bank. In the summer, you give clients umbrellas, but in the autumn, when it starts to rain, you take them back. That's one of the rules of a bank. Give umbrellas for free, but take them back when it starts to rain. But I think with accumulators, it's really something that we also make valuations of those in the system. And we see them in the coffee market, in the corn market, sometimes in the metal market, not that much. But for me, it's just a warning that I want to give. Yes, nice products, but please be sure that you know what you do. So just to wrap it up a little bit on the portfolio and risk management, we really focus on risk in a broad perspective. We also make valuations of power plants, of windmills, of solar parks, so different parts of the focus. Because the large industrials that we talk to, they all want to be green. So yes, they have a few windmills. Yes, they buy some credits from a solar park. But we do those kind of things as well. And it's all combined in one big platform. And we work together with parties like Dycotrade from the EP side. They really focus on the EP side of systems. And we really focus, for example, on the risk side. We also work together with a US-based partner, Headstar, accounting firm. But maybe this is also a good moment for you to raise questions if you have any. Either on the software, on a particular case, or another question that you want to add about the weather, whatever. Feel free. Is anyone here calculating volatility himself? No? So we all trust systems, or you calculate it yourself?
Yeah, do you include a skew in your...
Yeah, we do. Yeah. Volatility smile, yeah.
Yeah, so you include a volatility smile. So for physicals, if you're looking at a portfolio that has physical, are you able to capture, runoff in a, let's say, an averaging period as you price, let's say, 30 days of average rate swap?
Yeah. We do all those averaging, we do as well. Because that's what we see, for example, in the metal market quite often. Sure. The price for physical delivery in January is based upon the average of maybe October until December. Those kind of averaging. And that's also important for calculating, for example, for clients, the underlying exposures. For example, if you're a beer producer and you're selling 100 million hectoliters of beer in 27, then with systems like this, we can also calculate the underlying exposure of aluminum, grains, barley, and energy. Because if you have your conversion factors, then the system can calculate your bill of material. And with the bill of material, we have the curves, and with the curves, we have the potential cash flows.
And are you able to also include, let's say, location spreads and quality spreads in a regionalized portfolio where you might be sourcing the corn because it's cheaper from one location, but your pork is being delivered to another location, and then you have freight. So
yeah, exactly. Yeah. That's what we see in the dairy market as well.
Yeah.
With the cheeses, with the milk, with the butter. It's the same concept.
So how do you capture, let's say, with cheese, the temporal component of taking the raw material and then, the cheese comes at X days in the future? Yeah.
Kerry is, for example, one of our clients, and they think about caseins and proteins, and And then for me it gets difficult. It became difficult, but okay, after 10 years speaking to these kind of clients, you start to know what they're looking for.
Sure.
And for them, for example, they also measure the effectiveness in terms of, yes, in April the grass starts to grow. It's higher than 12 degrees, so the grass starts to grow. The cows start eating, so the milk production comes. So you also have the bell curve in the milk production. And they measure upfront, okay, what do we expect on the calculations? 1 billion liters of milk, so we think we are going to produce these amounts of yogurts and butter and all the products that they're selling. And then afterwards they measure, okay, is our effectiveness really in line with what we expected, yes or no?
So they're back testing it then?
Yeah,
basically.
they are back testing, yeah.
That's great, thank you.
Okay.
Roman, KfW, Germany. My question is, the banks use in the project finance cash flow models. I'm sure you know, because you used to work for a bank. And these models are quite complicated, quite sophisticated. They're built for forecast for 15, 20 years, all Excel-based, and the technology is probably 20 years old, so used till today. So if a bank finance, for example, I don't know, road to be paid somewhere in Spain, they consider all the different factors to understand whether the project will work or not. And this covers both finance costs, but all the different economical factors. So what is the principal difference in what you are offering to the technology which bank have been using for the last 20 years? The question is, where is your bacon breakfast in Italy?
I think with a lot of technologies, I think there are a lot of good things out there. I think that's the truth. And very often it's a personalized thing. Sometimes it's just a picture that some clients like far better than another picture. Sometimes it's the way how data is calculated. So I think there's a lot of good systems out there. We're one of them. Are we better than the rest? I don't know. I think that's up for the clients to decide. Are we good? Yes, because that's what you also see when you get a client on board, and if he leaves after 2 years, you know, okay, something went wrong. Is that us or is that the client? And first, of course, you start with yourself. But if I see that 99.9% of the clients are still with us after 10 years, then I think we're doing a good thing.
Okay, well, thank you very much for the presentation. If you have any questions, what we do, we can pick them up out in the lobby, okay? Thank you.